Hello everyone, thank you for coming to my channel. Today I will read the paper Monetary Policy and Market Interest Rates. It is written by Tor Ellingson and Alf Soderstrom. This paper is published in the American Economic Review, which is a top journal in the economic field. Monetary policy and market interest rates. Understanding the relationship between monetary policy and market interest rates is of utmost importance to bond traders and central banks alike. Unanticipated changes in monetary policy strongly affect interest rates of almost all maturities, representing recurrent opportunities for traders to win or lose money. All serious bond analysts have their own quantitative model of the past relationship between policy moves and the yield curve. Policymakers, on the other hand, carefully watch the yield curve for news about market expectations. Academic economists are interested too. The effects of monetary policy on the real economy is one of our discipline's more controversial topics. Given these efforts, our understanding of yield curve movements remains remarkably incomplete. True, there are some statistical irregularities. It is empirically well established that monetary policy affects market interest rates, and that on average this relationship is positive, and an increase in the central bank rates lead to an increase in interest rates of all maturities. It is also well known, however, that there are many exceptions to the rule. For example, on a number of occasions in 1994, when the Federal Reserve announced an increase in its target rate, interest rates of long maturities fell, as noted by Tom Skinner and Zettel Mayer, 1995, who studied the interest rate response to monetary policy over long periods in four major economies. The fraction of such abnormal responses is considerable in all countries. At the moment, there is no coherent theory which tells us whether the yield curve will shift or rotate after a policy change. Some argue that the curve should always shift. For example, Cook and Han, 1989, who first firmly established the positive empirical relationship between target rates and long rates, interpret their finding as supportive of the expectation series of the term structure. The expectation theory says that a long interest rate should be equal to the average of short interest rates over the same period of time plus a term premium. Thus, an increase in the first couple of short rates should drive up the long rate too, but by less. Cristiano Romer and David Romer 2000 disagree. To them, the positive movement in the long rate is inconsistent with standard theory, a puzzle. According to receipt theory, they claim an increase in short rates should reduce inflation and hence reduce the level of sufficiently long rates. Romer and Romer suggest that the puzzle can be resolved if the central bank have access to private information about economic fundamentals, but they do not develop their argument formally. In this paper, we provide a simple model within which each of the three mechanisms captured by the standard theory, the expectations hypothesis and Romer 2000 respectively, are all at play. Our argument centers around the presumption that a change in monetary policy can come about for two distinct reasons. Either the monetary authorities respond to new and possibly private knowledge about the economy, or their policy preferences changes. In the first case, policy is essentially endogenous, reflecting new input into a given objective function. In the second case, policy is exogenous, in the sense that the input is the same but the objective function is new. After an endogenous policy action, Our model predicts that interest rates of all maturities move in the same direction as the policy innovation. After an exogenous policy action, on the other hand, short and long interest rates should move in opposite directions. Let us now describe our approach in a little more detail. Our theoretical model is taken from Lord Svensson, 1997 and 1999, and is quite simple, with reduced form relationships for output and inflation. Key features of the economy are that shocks to output and inflation have persistent effects, and that monetary policy affects output and inflation with a lag. To this model, we add an equation describing the term structure of interest rates. The central bank is assumed to control the one-period interest rate and to minimize the loss function, which is quadratic in the variations of output and inflation from target. The simplified treatment of the economy allows us to derive the central bank's reaction function endogenously and to obtain a closed-form expression for the yield curve. Assuming that the expectations hypothesis of the term structure holds, the model yields the following set of predictions. Suppose the central bank's objective function is known and stable. Whenever an economic shock is symmetrically observed by all agents, market interest rates respond immediately and the change in the central bank rate is fully anticipated. In this case, all interest rates move in the same direction. Unanticipated change in the central bank's rate can occur for two separate reasons. First, the central bank may have private information about exogenous shocks to output and prices. In this case, an increase in the short interest rate could be interpreted by market participants as an indication of increased inflation, and as the central bank acts to squeeze inflation out of the economy, interest rates of all maturities goes up. The existence of central bank private information in the United States has been documented by Romer and Romer 2000, who suggest that the source of private information is likely to be superior data processing abilities at the Federal Reserve, rather than early access to data. Second, the central bank's preference may changes. The policy preferences of the central bank are captured by the parameter lambda, which measures the weight on output stabilization relative to inflation stabilization in the bank's objective function. Thus, if the short interest rate is increased and bond traders are confident that there has been no unanticipated change in the fundamentals, then they will typically infer that inflation stabilization has moved higher on the central bank's agenda. In this case, we show that sufficiently long interest rates will move in the opposite direction because average inflation is reduced. We also note that lambda determines the magnitude of the interest rate response to fundamental shocks. For a given shock, short rates respond less and long rates more as we increase lambda. That's all for today's listening. Thank you for your listening.